Hey guys, my name is Evan and welcome to Evanomics 101, your number one source for everything econ. Have you ever looked at a stock for, let's say, $20 and thought, oh, that's kind of cheap? Or maybe you saw another stock trading at $500 and assumed that was a stock that would be more expensive. Well, one of the biggest investing mistakes that a lot of beginners make is believing that a stock's price tells you how valuable a company is. It really doesn't. Today, we're going to break down exactly how Wall Street values publicly traded companies. And by the end of the video, you'll understand why a $20 stock can actually be more expensive than a $500 stock. Today, we're going to cover what company valuations actually means, the numbers investors look at, and how to tell if a company is overvalued or undervalued. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy these simple breakdowns, please hit the like button, subscribe, and share so you never miss out on another. This right here, a lot better. Hey guys, my name is Evan, and welcome to Evanomics 101, your number one source for everything econ. Have you ever looked at a stock trading for, let's say, $20 and thought to yourself, that's kind of cheap? Or maybe you saw another stock trading at like and assumed that has to be expensive. Well, one of the biggest investing mistakes that a lot of, especially beginners, make is believing that a stock's price tells you how valuable a company is. It really doesn't. Well, there's more to it than that. In today's video, we're going to break down exactly how Wall Street values publicly traded companies. And by the end of the video, you'll be able to understand a little bit better why a $20 stock can actually be more expensive than a $500 stock. Today, we're going to cover what company valuations actually means, the investors look at, and how to tell a company if a company might be overvalued or undervalued. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple breakdowns of economics, finance, the markets, geopolitics, please like, subscribe, share so you don't miss out on future videos. Let's go ahead and dive in. So, what is valuation? We're going to start with the basics. Okay, valuation simply an estimate of what a company is worth. Think about a house. You pay whatever price the seller asks without considering a couple of different factors. So if you were buying a house, just give an example. If you were buying a house, you would be asking questions about the location of the property, the condition of the property. You would be asking about what the properties in the neighborhood or in the area sold. What prices did they sell for? Stocks kind of work the same way. Investors aren't just buying a ticker symbol. They're buying ownership in a real business. So naturally, they want to know as much as possible. What is the business actually worth? What's the valuation? Okay. So we're going to break it down to the simplest form. Okay. The thing we're going to look at when we're talking about a company's valuation, we're going to talk about market cap or market capitalization is short for market cap is short for market capitalization. And the formula is market cap equals share price multiplied by the number of shares outstanding. So just a quick example to help you kind of market cap is. So say you have company A that has 100 million shares. Each share trades for $50. The market cap is 100 million times $50, which would equal $5 billion. Did you notice something when an example? Did you notice that the share price alone tells you almost nothing? A $500 stock isn't automatically worth more than a $50 stock. It's the total value of shares outstanding that really matters, or that also matters. All right. Now let's talk about, because ultimately, if you're running a business, you're there to make money. Investors want businesses that can consistently generate earnings and grow those earnings over a longer period of time. Imagine you have two companies. Company A earns 10 billion every year. Company B earns just 500 million every year. Even both have similar market cap, investors will value them very differently. Growing profits generally increases valuations because investors expect larger future cash flows. That's why quarterly earning reports often cause huge stock price swings. For a second, if you want more breakdowns like this that simplify investing, and please hit the like button, share, and subscribe. Let's go ahead and hop back in real quick. So now we're going to talk about why valuations change, because they are changing. They valuations aren't fixed; they're consistently. And here are some of the reasons why a valuation of a company may possibly change. Higher earnings, new products offered, interest rates, economic growth, recessions, when we have decisions made by the Federal Reserve. So changes to monetary policy. Even headlines can move valuations. That's why stock prices they fluctuate every single trading day. The market isn't consistently trying to determine what companies are worth based on new information. Here are we're going to talk about mistakes that beginners make when trying to value or determine the value of a company. The first one is really buying a stock just because it's cheap or what you consider cheap. A stock isn't automatically a bargain. So the second thing that the second mistake that people make when valuing a company is ignoring earnings. Revenue is great. Profits are the key though. If company has to have profit, bringing in money is awesome. But if a company doesn't have profits, it's it's pointless. And the third reason, looking at only one metric is what you want to do. You want to be able to look over a wide range of different metrics in order to determine what the value of that company is going to be. So the biggest takeaway from this video is valuation isn't about just guessing, it's about estimating what a business is truly worth based on its financial performance, its growth potential, and future expectations. The more you understand valuation, the better investor you can become. Instead of chasing hype, you start evaluating businesses like you're an owner. If you enjoyed today's video, please don't forget to hit the like button, subscribe, and share this with someone who's learning more about investing or the market. And let me know in the comments, what publicly traded companies should we value together in a future episode? Thank you for watching. Again, this is Economics 101, your number one source for everything econ.